Everybody, thanks for jumping in today and thanks for waiting an extra minute as we just ironed out a quick little tech issue, as was always going to happen. Great to have you here. My name is Alison Bird. I am a program manager here at Climate Salad. It's really great to be with you today. This is a special session, this Navigating a Successful Series A from Preparation to Post-Action, in that this is being offered to those who responded to our industry report survey this year, just as a big thank you for doing that. So it will be a slightly smaller group and hopefully plenty of time for asking questions as well. Before we dive in, I'd like to start by acknowledging the traditional custodians of the land on which we're gathering today, which will be different for all of us. For me, that's the Midjabul people of the Bundjalung Nation, and I'd like to pay my respect to elders past and present and extend that respect to any Indigenous people who may be joining us today. If you haven't already got your name on your Zoom name and your business, feel free to pop that on your name or to pop it in the chat. You can also share where you're tuning in from today as well. Just before we start our discussion with Lewis and Steven, I'm going to pass it over to Olivia Utantam, who's going to give us a little bit of an insight, a little sneak preview into some of the data that we might be seeing from the 2024 Australian Climate Tech Industry Report. Olivia, can you give us a quick update?
Hello, everyone. Firstly, I just wanted to say, oh, there we go, I'm spotlighted. First, I'd just love to say a huge thank you to each of you for filling out the industry report. I know it's a pretty big survey and it takes a good chunk of time, but we're now into our third year of data collection and we've got some really incredible insights into the state of Australian climate tech and how it's building and progressing. And we get asked all the time by government, by corporates, and by investors, who's out there, what are the companies doing, what are they building, and where do they need the most support. And so without the data that you provide, we wouldn't be able to showcase your businesses to those stakeholders and we wouldn't be able to help grow the ecosystem. So thank you so much. With that in mind, I'd love to, and I'm very excited to give you a bit of a sneak peek into this year's industry report. I'm going to share my screen and hopefully you'll be able to see for the very first time. Oh, can you see that? Or it's paused?
It's just paused. It's having a think about it.
Yeah, okay. Let me give it another go. Maybe I'll go off my full screen. There we go. We were just saying earlier that you'd think after so many years of Zoom, we'd be able to work this out, but still
there we go. That's
a work in progress.
We can see that.
Wonderful. So obviously we're still working on the design, but these are our key insights from this year's data. We've got an incredible 689 climate tech companies in Climate Salad, and there are more around Australia. But really importantly, we've already made a big difference to the amount of carbon reductions already taken out of the atmosphere or prevented from being emitted. So huge thank you to all of you who are doing the hard yards. Climate Salad just loves to kind of amplify that and celebrate that. I'm really proud that it's a diverse community as well. 42% of our founding teams have at least one female founder. There's something to be said about the spread of capital across founding teams, but we can maybe talk about that with Steven and Lewis in a second. But in total, we've raised 1.4 billion of capital to date from those companies. So huge amount of capital raised and a lot more still to be raised as you all scale and grow. Importantly, we've got a ton of jobs in climate tech and more people want to jump into the sector. I had coffee with someone who worked for Qantas and Cochlear in the finance capacity for many years today, and he wants to move into climate tech. So we're seeing more and more really talented people come into the space to support the growth of your businesses as well. We're looking internationally. We've raised 370 mil of international dollars to date. So Australian investors, they need to step up their game because otherwise we're just going to keep looking overseas to secure capital. And as a sector, we're really positive and optimistic about the impact that we can have on carbon removal and reduction to 2030. So those are some key stats and some key highlights from the industry report, and really excited for you guys to be the first really ever to see it for this year. What does that mean directly for your business though? We are now showcasing your businesses in the Climate Tech Insights platform. Some of you may have seen it, but it might be new to others, and I'll just quickly whiz through it because we want to have a great chat with Steven and Lewis. But now we've got investors, government, and corporates and potential customers subscribing to this Climate Tech Insights platform, where and it's all the privacy and the data privacy is controlled by each of you individually for your business. But corporates want to find solutions, and by going into this insights platform, they can now do that easier than before and find your business. So based on the level of privacy that you've set, they can actually search for sectors, for stages, for states, and for solutions. So I'd highly encourage, if you haven't already checked out, it's the Climate Tech Climate Salad members platform that you all have access to through your email that you've subscribed to Climate Salad for. You go into your profile and update that, because we do have corporates and investors looking through this every day. So for example, this is the information that Elliott Energy have made public, and now I think we've got over 100 subscribers now, looking through the platform to find your solutions, to invest into your solutions, and to buy your product. So a huge thank you for filling out the industry report survey once again. And we're really excited to showcase you in the report and on this platform more prominently than ever before. And with that, I will pass back to Alison.
Thanks, Olivia. And I've just popped in the chat there. Our official online launch for the industry report is on the 6th of August. We'd absolutely love to see you there. There's a link there, but you'll also see more information on that in the upcoming newsletters as well. So I'm delighted now to start our conversation about navigating a successful Series A with two founders who have done just that. Where a big warm welcome to Dr. Lewis Dunnigan, who is the founder and managing director of Bygen, and Steven Vassiloudis, founder and CEO of Novalith. Before we really dive into that discussion, do you want to each give us just a quick pitch? I'm sure you've done that a million times now. Steven, do you want to start by giving a quick pitch of Novalith for us?
Yeah, sure. And thanks for inviting us and having us chat today. So Novalith, we developed a new technology to extract lithium from lithium-bearing ores. And so if you think about the world in 5, 10, 15 years, and even now to a larger degree, it requires electrification. And as part of that, you need to store that energy somewhere, be it EV or otherwise. The key kind of metal to do that is lithium, but the current ways of producing lithium are pretty cost inefficient. And environmentally, it's not really kind of matching the green future that we're looking to work towards. And so with our technology, much cheaper, much faster, and much more sustainable. And that was really the genesis of Novalith, was finding a way to accelerate the transition towards an electric future cost effectively and sustainably. And in terms of, I guess, progress to date, so we kicked everything off in about 21 with a seed, raised our Series A about a year later. Well, 2 years later we closed, and we can talk more about the timing and how long it actually takes to lock down a Series A. It's often longer than you think. But since then, we scaled from milligrams in a lab all the way through to pilot. And now moving forward, we're looking to commercially deploy at much larger scale, and looking, again, overseas and not just within Australia.
Thanks, Steven. I've got a few questions already, but I'll hold off. Lewis, do you want to also give us a quick pitch as well?
Yep, absolutely. And just confirming you can hear me still? It's still working?
Loud and clear.
Okay,
yeah.
Great. Yeah, so we're Bygen. We basically are commercializing technology we developed that allows us to make a material called activated carbon a lot cheaper and a lot more sustainably than the conventional ways it's made. It's a bit funny because activated carbon, a lot of people haven't really heard of it, but it's a really crucial filter material in a wide range of industries like drinking water treatment, polluted soil remediation, industrial gas scrubbing. So it's kind of an essential tool in the arsenal of technologies to kind of meet APA standards and things like that. So it's very important, but no one was really looking at it, and it was still being made the same way it had been for 100 years, which is you take coal, heat it up to very high temperatures, and react it with steam, get activated carbon at the other end, and we kind of developed a way that uses sustainable alternatives to coal. It's a lot lower energy consumption. And yeah, we did our seed round in late 2020 and closed our Series A earlier this year. But yeah, like Steven alluded to, it was a long process to get that across the line. And looking back on it, you kind of are surprised you were able to do it and still keep the company running at the same time. So yeah, that's basically our story.
Thanks, Lewis. Yeah, I think we'll touch on timing and how do you still manage to run the company at the same time. But before we go down that path, I'm curious, because really a Series A can mean something different for everybody. Perhaps starting with you again, Steven, what did a Series A look like for you in the context of those previous funding rounds? You mentioned that seed round, but yeah, how did you kind of how did you define it?
That's a good question. And I think depending on who you talk to in different industries have, again, a very different understanding of, pre-seed, seed, Series A, et cetera. Software guys, by the time you're talking about, Series A and B, large sums of money are generally generating revenue. For us in kind of deep tech, climate tech, not really. This is kind of like, you've kind of gotten things out of the lab and you're looking now to scale up to the point where you can then raise substantial sums to then build something at kind of pre-commercial or commercial scale. And so for us, it was pretty much that. So the seed round, we kind of, again, we designed the round, so we costed everything out for both kind of cost and time to get to a certain point, right? Which would then give us enough information to feel comfortable raising significantly, more capital to then unlock that next, say, big milestone, which would be technical development advancement, as well as tying up the tech economics. And so that really underpins everything we're doing. So you kind of do a bit of lab work. You then have to get that validated to make sure it actually makes sense financially and scales effectively, right, as you try and commercialize your tech. And so that was really it for that Series A. So we raised 15 million US, and that was led out of the US. And that was really to pilot the technology at kind of that pre-commercial scale. And the way we developed, I guess, the narrative going into that round was really around that. We're comfortable with the technology at lab and benchtop, and now we need funding to unlock the next phase of development.
And in terms of having that kind of US base for that, what did your ops look like there? Did you have to set up a topco there? How did that kind of work for you?
Thankfully not. Everything was done from Australia, and we're still kind of headquartered in Sydney, although we do have offices in Perth and in the US, the Bay. A lot of US investors are not super keen to invest outside of the US, and so it does reduce your pool a little bit. But in saying that, a lot of them are still very open to investing ex-US. And I think from our seed round, we had the Grantha Foundation come on board, not based in Australia. We had the CFC, fair enough. But then for the Series A, we know Low Carbon Capital, TDK Ventures, both traditionally US-based funds, and there was no real issue. I mean, one of the reasons we looked to the US was just that ability to kind of fund future raises. And so when you're looking at your development pathway and your commercialization pathway, is making sure you're partnering with the right people, right? So that, fair enough, you need to kind of, plug the gap now to get that next phase. But then if you have to kind of restart your relationships the whole way through each round, it's going to be a very difficult journey to get full scale.
Yeah, absolutely. And Lewis, I mean, this is an interesting conversation, I suppose, in that you've both got that kind of hardware, deep tech, and I know that many in our audience have got more of that kind of software experience. So noting that it is a little bit different. But can you tell us a little bit about what did a Series A look like for you? And again, you mentioned that seed round in kind of 2020. But yeah, how did you define your Series A?
I think it depends who you ask. I mean, obviously the dollar amount is quite important, and we were quite low in terms of we raised a lot less than Steven did, but that's really just the nature of our business, and we weren't trying to hide that. We are hardware, but a combination of the fact that the actual plants themselves are not incredibly expensive compared to how expensive hardware can be. One of our full-scale commercial systems, the plant equipment's around about $2 million. And we had managed to progress the technology to kind of pre-commercial levels just off the back of the seed round and other income streams that we're able to generate. So for us, this was really about raising the amount of money we needed to build out the team, the internal resources, the warehouse and logistic capabilities, that the pipeline of customers and orders that we had for our hardware could be delivered and we could actually execute on the projects that we had in the pipeline. So we weren't really raising to build the next iteration of a plant. We kind of had customers who were willing to take on some of that risk. It's very, very challenging in the hardware space. It's such a chicken and egg thing. And that's why you often have to go to investors to get that funding. We were maybe just a little bit further along, combined with the fact it's not incredibly expensive hardware, that we were able to get a customer and a partner to help build out that next stage and just kind of use the funding to support those projects.
Yeah, and you've hinted to that a little bit, but how did you determine the amount of funding? Was it really looking at crunching the numbers of what it's going to take to cover the team and sort of those next steps for you?
Yeah, essentially doing your 2-3 year cash forecast. We use very conservative assumptions around how long things will take, big contingencies on costs, put that all together, figure out how much you need to survive to the next key milestone, which for us is having our next production plant up and running with large volumes of product going out to customers. So yeah, we crunched the numbers, figured out how much we needed, and it's kind of combined that with what the 12 months, 24 month strategy for the company was, and that's what dictated how much we needed to raise.
And can you, Lewis, tell us a little bit about your capital stack?
So in terms of like who we raised from, how much?
That you're happy to share?
Yeah, absolutely. So we've raised some from both VCs and family offices. The VCs we've raised from are mostly in the climate tech space. We've got some sort of well-known Australian investors in that space on our cap table. Then we had a family office come in the last round, very much focused on the impact side of what we do. Some differences between how a VC looks at an investment and how the family office would look at it. I think the family office was very focused on impact, whereas a VC was certainly pushing us on the numbers and a little bit more of a granular level of detail. So yeah, that's we didn't really look at our sources of funding. We're not in a position to raise debt or anything like that. So yeah, it was just a natural progression.
And were there any differences in the kind of due diligence process with the family office to the VCs, and how did you go about addressing them?
Well, I think the impact was massive for them. They really needed to validate that with scale came significant positive outcomes. That's really the mandate for their whole investment ethos. Not that that's not the case with the VCs as well, but I think the angle at which they were looking at the investment was just slightly different in terms of how the impact was assessed, what metrics were being used, et cetera, et cetera. So that was probably the main thing. But I think from family office to family office, I think there's different processes. The one that we went with, there was an element of, there were similarities between how they looked at the investment and how a VC would look at it. What's the projected return on investment? What's your financial projections? Are the unit economics sound? Have you got a pipeline and contracts with customers in place? They're not going to give you money just purely because you've got a technology that does good for the environment. But they're also not going to give you money just because you have a sound financial return with no impact as well.
Yeah, that makes sense. Steven, I'm curious. You mentioned about the Grantham kind of environmental trust, and I'm curious how that kind of came about and whether there were any risks and opportunities, I suppose, associated with receiving funding from that kind of organization.
Yeah, so it's a bit like Lewis's experience with the Impact Fund. For the Grantham Foundation, they were very much driven by impact, right? Same thing for them. Lowering CO2 was the main focus. And with our technology, we have significant impact in terms of the CO2, produced on a ton basis compared to the conventional. And so that was a major driver for them. For us, as part of that, we had to have a kind of real thinking: are they the right partner for us long term? Given the other investments they've done, kind of reputability in the investment space, and also through their network. And it's one of those things, I think, for everyone, you have to see if they're the right investor for you, if they're the kind of right fit for your company long term. We didn't really have any negatives. And so we decided that it was a good thing for us to run with. And there's also one of those things, depending on the market at the time, like, when kind of money is falling from the sky, great, you can be really, really picky. But in the same respect, like now, raising cash is not super easy, potentially, less picky, and you have to survive. You need cash to survive.
Yeah, exactly. And you've both mentioned that time frame, and it sounded like it took perhaps a little bit longer than what you had initially anticipated. So how and when did you start building relationships with investors for your Series A? Whoever wants to jump in first. Yeah.
So from our side, it was about 12 months prior. I'm starting to have the conversations and just kind of getting people up to speed with what you're doing and why it's exciting. But then subsequent to that, once you actually have a term sheet on the table, it takes 3 times longer than you expect it to. It's herding cats. There's so many little things that you have to iron out. It takes forever and a day. And so I think going back to the point around timeline, and kind of costing that out to say the 2 or 3 years, you have to also be a bit conservative around, or put in a bit of contingency for time to close.
Yeah, with us, I mean, we had some existing relationships with some of the investors that came on. A few of them were kind of brand new ones. Really, it was sort of October, November 2022 when we started to reach out to them and say that we were planning on doing it. We just had to meet some sort of significant milestones before we felt comfortable going out to them. Once we did that, we probably formally started the process around March 2023. And then we had term sheets around September, October, and then we closed it around about Christmas. So those were the timelines for us.
And those milestones that you mentioned, were they ones that you'd put in place for yourselves, or was that sort of suggested by some of the potential investors?
We had an idea in our head of what they would want to see to make an investment to de-risk it. And it was a combination of technical and commercial. And I wanted to make sure that I was thinking about it the right way. So I had friendly conversations with them to say, look, this is what I'm planning on doing. Do you think that this will get us to a point where we're investable from your point of view? Took on board the feedback. You don't necessarily want to let investors dictate your whole company strategy, but it was also good for filtering out those that maybe just didn't agree with what we were doing. We have quite a licensing heavy approach in the hardware space, so it's a little different. Some investors just want to build, own, operate plants, and that's fine. But I'm sure Steven can tell you can waste a lot of time talking to investors who it's never going to be a right fit. And you really want to try and filter that out as early as possible.
Steven, was that your experience as well?
Yeah, no, that's a great point, Liz. I think that's it. Is spending the time early on with the investors and kind of weeding out the guys who just aren't the right fit and who'll be wasting your time down the track. It's a lot of effort trying to raise. I mean, just going to the time that Lewis kind of noted there. And for every investor, they can ask 100 questions. And if you have 100 investors asking 100 questions, you just don't have enough time in a day, right? Never mind actually delivering all these milestones which you've set yourself to enable the raise. And so finding the right investor and making sure that everyone's kind of mission aligned early on is super important.
And just to add to that, I'm not sure what Steven's experience was, but in Australia in particular, there's a lot of investors who will follow lead investors, but won't necessarily lead. And very quickly, you have to figure out actually who here does have the appetite to lead it, either because their minimum check size is right for us. There was quite a few that we talked to that was like 500K or less. And it was like, well, we can have a lot of them dotted together subject to finding a lead, but we're not going to have a lead, so they're not going to invest. And then for us, once we had the lead, we actually became oversubscribed because we had quite a few of those smaller checks and we had to turn down a few. So identifying who the lead can be quite early on is also important, because you could get lots of investors ready to invest subject to finding a lead, but you've wasted your time if you never find that lead in the end anyway.
So interesting. Yeah, I wonder what that says about the Australian culture more broadly, if we're just waiting for that lead investor. Did you find, I mean, Steven, you mentioned that you've got some starting that kind of from the US. Did you see any different behavior having investors based in the US from Australia as well?
Different mindset. But yeah, and in terms of our experience kind of finding the lead, it's a really good point and a really important point as well, right? Because you don't want to have 100 people in the cap table. You'd rather have a strong lead and a few who follow into that. And I think you're kind of interviewing your investors along the way as much as they're interviewing you. And that's, going back to the right fit is trying to identify those leads early on through, similar investments and even those early conversations. What's the ticket size or minimum ticket size they're willing to write, max ticket size, and just kind of getting comfortable with them early on. And then in terms of the Australian versus the US mindset, honestly, in the VC community, it is like night and day. I think the Australians are a little bit more conservative, not willing to take as much risk, whereas the US are like, go big, go home. And it depends on also what you're doing as to where the right place to raise is. For us, I mean, a commercial plant for what we're doing is, circa 400 mil. And so the quantum of capital is tremendous. And so for us to get that type of money out of Australia would have been very difficult, right? Given the depth of the community here. Whereas in the US, you're talking about, $500 million, $1 billion raises, pretty often in the VC space. It's not unheard of. I mean, a good example, I think Hysata raised, it was 150 million or something. And that was the biggest clean tech raise that had ever been done ever in Australia. Whereas in the US, there's a lot more kind of positive news for around that quantum. And so I think from that US perspective, for us, it made a lot of sense. But that doesn't necessarily mean that it's going to make sense for all the different companies.
Yeah, absolutely. Just looking here, we've got a few questions coming in that we might just pause and make sure we cover. The first one was just about how did you go about finding that lead investor, and were lead investors encouraged by the presence of follow investors as well? That was from Matthew.
Do you want to go, Steve?
Yeah.
Okay, I'll go for this.
Oh, okay. So in our case, I mean, I think it's pretty well known who the potential investors are in Australia that can lead around. And you can, in our case, we were really talking to all of them. I mean, full disclosure, a few of them had passed on our seed round, and I'd still reached out to them and said, are you interested? We're doing another raise. Here's the things we've done. And the answer was still no, and that's fine. It was just, we didn't fit into their investment ethos or, any potential issues. Maybe they just don't think we're a good company. But we reached out to everyone, understood kind of what the check sizes were relatively, tried to piece it together. When we kind of identified which ones could lead, we had to really go hard and try and figure out which one of them would get the conviction to lead the round. So yeah, it was really about having as many conversations as possible and quickly figuring out which ones are viable options and which ones just aren't going to work out. And on the point about the follow-on investors, I think it definitely helps that you've got smaller checks waiting for a lead. They want this. All the investors that we talked to who were potential leads wanted to have a minimum raise amount, and you needed to piece it together. But generally, I think if you've got a lead who's willing to put in the biggest check, they've got enough conviction themselves that they're not really relying on smaller investors to get them over the line.
Steven, did you have anything else you wanted to add to that?
Yeah, no, I think that was very much experience as well. It's a bit like kind of a sales funnel, right? So you have to chat to a lot of people early on. And then as you progress and kind of things kind of warm up with certain investors, you'll get a good feel if they'll lead or not, right? I think they're pretty open about that. But you have to ask them the question, do you guys normally lead rounds or do you follow? But then, off the back of that, she's kind of throwing the effort behind the ones that will really kind of get you there. And I think, in our experience as well, you can have a whole bunch of followers, but really it's once you've got that lead kind of locked in that everything starts to precipitate, and it really kind of speeds up at that point. So, and I guess the other kind of experience we've had, just keeping everyone warm. You know, like you have to have regular contact with the investors, keep them kind of up to speed with what you're up to, and go back. That's a good point. So from our eyes as well, we had a few people who said no early stage, but it came in later stage just because we were too early. They needed to see A, B, or C, which we hadn't done yet. Right, we did it as part of our seed, and they jumped on in the Series A. So I guess never take a no for a no to start.
Yeah, and you mentioned there about starting those conversations really early on, and I know that this is something that Mick Levinskas talks about all the time. It's like you need to build those relationships early, right? Like just same as if somebody was hitting you up for money personally, if you don't know the person, you're not going to give them the money usually, but if you've got that longer relationship and you know each other better, then you're in a different place. How another question here from Daniel. How close to your starting ask did you end up with, both money raised and equity given up?
In our case, we ended up oversubscribed slightly. We ended up having a cap put in place by our lead investor. We probably could have gone a bit higher, but we were really wanted to close it because we were coming up to the Christmas break, and we were already oversubscribed, so there wasn't a real need for additional funds. So yeah, that was our experience, and there wasn't a great deal of negotiation on the valuation. But what I will say is, my memory of our seed round was that valuations were a lot easier to justify than they are now. They seem to be pushing a lot harder on that and testing a lot, questioning a lot of the assumptions of how you arrive at that valuation. So I think there has been a bit of a change in the last couple of years.
Yeah, and you think that's reflective of the market that we're in? Yeah,
for sure.
And you've mentioned, Steven, that you had that kind of base in the US. Did you look at Europe at all for investment, or was it really sort of the US was the right sort of market?
Oh, we looked at Europe as well. Europe has some awesome investors in our space. But for what we were doing, and if you look at, and I get it, it's pretty company and market specific. For what we're doing, there's a lot of lithium in Australia, a lot of demand for lithium in Asia, but then the next kind of biggest market is the US. There's a lot of lithium in the US and kind of the end use case as well. Europe is a little bit behind. And so for us at that time, the US made sense. Casting forward a year or two, I think Europe is going to be a really good spot for downstream battery materials as well. And so that's not to say that our next round won't also have potential European investors.
Fantastic. Thanks to folks who are putting the questions in. Hopefully we'll get to all of them as we go through. And I'm curious with your with the kind of due diligence process, and you've touched on this a little bit, but were there any kind of particularly challenging aspects to it? Lewis, we might start with you.
I wouldn't say that it was significantly different to the seed round. I would say that a lot more emphasis was placed on our contracts and any agreements that we had with customers. I think with the seed round, it was really about validating it's a good idea, and there's technical milestones to make, and if you get it right, there'll be customers, but not necessarily signed up already to contracts. Whereas by the time we got to our last round, because we were so close to commercialization, we needed to be demonstrating that we had offtake agreements, we had partners to build the plants with, that they were sound contracts, they weren't wishy-washy. In fact, we had some experiences where someone was close to looking to lead the round, but wanted us to change something in a contract we had with the customer, and that didn't quite work out. But I think a lot more emphasis was put on execution risk, in the sense that if we give you the funds, you have the pipeline, the agreements in place that you can go and execute and start making revenue off the back of kind of the technology and the idea. So it definitely was a big progression from the seed round, where it was just like, there's a big market, you've talked to some customers, they want the product, the unit economics make sense. And what I mean by that is, if you turn the machine on, it's not just going to lose money. Like, in principle, it will make money. And obviously the climate aspect's validated as well. So that was probably the main shift for us.
And how about you, Stephen?
Similar, but I think for us, the commercialization journey is a bit longer. And so for Lewis, kind of the seed where, you're confirming that it scales and commercializes. I mean, that's really what our kind of Series A is for. And so going to that Series A DD, a lot of it was more around technical and IP. So huge focus on IP, have your patents locked up, if not why and when. And then in terms of that technology scale-up plan or development plan, have you guys really got conviction that you can scale your technology effectively and that the unit economics make work? Because at the end of the day, it has to make financial sense at large scale or at commercial scale. Otherwise, there's no point in investing in it.
Yeah, I think that's a good point, and I think that might answer your question, Joanne. But wondering particularly here about did you have to make sure that you had a solid IP before seeking investment abroad, particularly in the US? But it sounds like that was absolutely the case, Steven.
Yeah, and that's a point actually. We didn't have patents granted, right, going into our seed. But the thing is, we had that IP, we had the date of prior art and all that. Oh, sorry, of priority dates and all that stuff locked up. So we did actually have a defendable IP strategy, which would be pretty important. I mean, at least for us in the kind of the deep tech space.
One of the things that we got pushed on was so our patents being granted in a few areas, and we kind of got pushed on what's to stop someone just kind of copying the patent, and how are you going to know that they're doing it, etc., which is quite a hard thing to defend. You get the patent, how are you going to find out if someone's actually using it? Particularly because we use quite off-the-shelf hardware, just the process is a little bit different. For us, we had to really demonstrate that we had trade secrets that essentially are within the company. They haven't been shared with anyone, and they are really the key thing of how you take this maybe standard off-the-shelf hardware and turn it into the grade of product that we make. So we had to really talk about a combination of the actual defensible patent side of things and also the trade secrets that we had to go along with it.
I can see why the journey was so long. Coming to like sort of balancing those investor rights and protections with maintaining control of the company yourself. How did you go with getting that balance right? Steven, maybe passing that to you.
Yeah, that's always a difficult one, right? Because the investors want all the control and they want everything for nothing, right? They're trying to kind of just maximize their investment. And you said you have to protect the company and make sure that you have enough kind of freedom to do what you need to do to make it successful. I think with investors, I mean, they're kind of conflicted to a degree in what they invest in, because yes, they want to invest and have ridiculously high returns, but they also want to protect their capital. And so a little bit of a juxtaposition there. For us, we relied on kind of strong legal advice and experience from other people who'd raised money as to, is this actually fair? Is this reasonable, realistic? Is this expected or seen? And you then have to kind of negotiate and try to find a good balance. And you're not going to get exactly what you want, and I think on the investor side as well. But you have to find that compromise which you feel and the investor feels can allow you to kind of keep on doing what you need to do to be successful.
Lewis, what about you? How was your experience?
Yeah, pretty similar. I mean, we were pretty clear from the get-go. We didn't want like a massive board or anything like that. We understood the need to bring in a new independent, and that was okay. We wanted to do that as a company anyway, so it wasn't really a change of mindset for us. Really, the biggest change for us now is we have more observers, and I think that's something that you have to get used to if you're bringing in VC funding. You have to get used to having multiple observers sitting on your board meetings. But yeah, I think we just relied on getting good advice, and we didn't have to deal with any kind of like cross-cultural issues because we didn't raise from overseas investors. So the Australian investors kind of are all operating in a fairly similar way. So it wasn't too complicated for us.
And Steven, you mentioned about getting like legal advice. Did that and getting advice from those who had gone through it before, did that extend to reviewing the term sheet as well? We know if you're a member of Climate Salad, Mick probably posts about this in our Slack channel once a week about making sure that you get somebody trusted to review the term sheet. How did that work for you?
Yeah, very much. So it was basically, hey, we have a term sheet on the table. What do you think? And we kind of spoke to a few kind of trusted advisors, and then also the legal firm that we were using. We were using Addison's. I think it's kind of public. They've seen a fair few deals in the space, and so they had a good idea as to is this kind of fair. And that was a starting point for then the negotiations from our side.
And Lewis, was that a similar approach for you?
Yeah, we have an advisory board. We leaned on them. We utilized legal advice from people that had seen multiple term sheets before. We actually did have to turn down the term sheet because it wasn't quite a fit for us, which was the first time that we've had to do that. But yeah, it was seeking as much advice, because I don't know about the other founders out there. You're stuck running the company, focusing on that. You don't necessarily always have time to read 100 different term sheets to learn about the intricacies of it. You have to really rely on external help. That's what we did as well.
So moving to that, given that it does take so much time and effort and to raise, and it does divert attention from the other aspects of the business operations, how did you effectively manage that raise while also still managing to run your business?
I don't know. Looking back, I'm not quite sure. It is like having a full-time job on top of a full-time job. I think maybe Steven was in the same boat. I ended up just like setting time during the week that would just focus on the capital raising and replying to certain things on that. There's no getting around it. It is a hard balance. And I think it's, you end up working more hours, unfortunately. That was our experience.
Yeah, very much the same, to be honest. It's just, you have to do it. You have to do both. And so you just make it work.
Yeah. Yeah. And throughout the process, did you have any metrics or milestones that you were using to kind of measure the success of your Series A investment? Was there a way that you're tracking progress?
We didn't have anything really complex. I mean, to be honest, I'd be happy to look at tools personally that might be able to. We just had a running, Excel spreadsheet around, where the progress was with each investor, how much they were looking to invest, keeping track of the amount, and what they were waiting on from us. But weren't using any sort of complex tools or anything like that. Certainly different to sort of managing some of our engineering projects. But maybe that was a fault of ours. Maybe there is a better way to manage it.
We did the same thing. The big Excel document, that was it.
Yeah.
Maybe that's the next business. And you've successfully, closed the Series A round. How did you go about deploying the capital raise? What were your kind of strategic priorities once that had closed, Steven?
So for us, as part of the raise, we basically had to have a plan, right? So the intended use of funds. And so then for us, it was really about making sure we started delivering on what we said we were going to deliver on. And I guess that's, if I could give any advice in terms of, getting comfort from investors, is if you say you're going to do something, do it. So can it really stick to your milestones and deliver on your milestones? It goes a long way in terms of building trust. And so for us, that was it. We said we'd, do A, B, and C by certain dates, and we kind of started working towards achieving those goals and milestones.
Yeah, same with us. We had a real urgent need to bring in some new people because we, had projects that were ongoing. I had to take a step back from basically leading the engineering work, and so I could focus more on, what's expected of management. So bringing in people, making the improvements to our warehouse to set ourselves up for sales, almost immediately, because really for us, it was just about waiting for the cash in the bank. Like we had everything ready to go by the time the race was finished. It was just about pulling the trigger on that.
And you've hinted, I think, a little bit, Steven, that those investor relationships, I guess, evolved a little bit after the Series A round, or at least delivering on the milestones that you said you were going to deliver on helps to build that trust. Were there any other ways that the kind of investor relationship evolved after the Series A round had closed that's worth mentioning from either of you?
I think, I mean, it's the board observers is a good point. So, I mean, obviously having them kind of being an integral part of the company, and actually having a say in how things are done versus sitting on the outside as an investor who you've had a couple of discussions with, and so obviously changes, right? I think it kind of strengthens the relationship to a degree, but then there's also things to manage in that, because at the end of the day, the investors want things done, say, a certain way, and that might not necessarily be what is best for the company at that time, whatever it may be. There's always these things to resolve. It's a lot of relationship, I guess, management through that. And then, I mean, beyond that, nothing really notable.
Yeah, I think when they become an observer, they see, the workings, the internal workings of the company in a lot more detail than they do when it's raised. Start talking about things that are a lot less glamorous, but that's what's needed when you're running a company. And I think what Steven was saying about making sure that you've got the right investors, if they're going to be on the board or the board observer, you want to be able to make sure that they contribute, or they're not going to give you bad advice. And luckily in our experience, it's been positive, but I could quickly imagine that if you had some, bad eggs, that it could get a little bit messy quite quickly. And it's difficult to untangle that once it's already happened.
Yeah, that's a really important point, and making sure that those relationships from the get-go are ones that you want to continue, because they're going to be long-term relationships. Simon's got a good question here. Did any existing or planned ESOP play into the negotiations for a dilutive impact at all?
So I can go first on this one. So we're a big fan of, I guess, ESOP. And the investors were as well, right? It's a great way to kind of motivate people long term. And so we agreed on a number for the ESOP, and we kind of stuck with that as part of the round. And we had to accommodate it, but it's one of those things that we felt was necessary. And so yes, it did have a dilutive impact. And there's a bit of a trade-off in terms of valuations versus dilution, etc., and that we kind of discussed. But yeah, we felt pretty strongly about it, and so we ensured that it happened.
Yeah, same for us. And actually, all of the investors that came in and existing shareholders, there was no friction around the ESOP. I think generally expect 10% is quite common. I think it also kind of depends on the stage of the company that you're at. If you're needing to hire people that are getting paid a lot of money, then maybe you need a little bit more ESOP to reduce that cash burn. But yeah, I'd be surprised if an investor would argue against having an ESOP despite the dilution.
Yeah, I guess it's often expected. In terms of managing those relationships with the board or with those investors, did you go about appointing an independent chair at all, and just generally on board dynamics? Any more insights on managing, being able to work together in the long term?
Yeah, we had to appoint an independent director within a certain period of time. But as I mentioned, we were planning on doing that anyway, and we wanted to make sure that we had someone come in who had a lot more governance experience and had experience of dealing with larger boards and multiple stakeholders, and it's actually been really useful to bring in that person. So yeah, that was something that we did, and I think it was a good idea.
Yeah, no, I think I'll definitely second that. I think having good experience in the board, an independent, right? It's kind of truly independent, and with the right kind of, either governance experience or industry experience or otherwise, goes a long way, I think. I think when VCs come to companies, they may not have all of that, say, domain expertise, right? They're investing in a lot of different companies, right? And I guess that's their job. And so helping them kind of make the right decisions, you do need people with that experience behind them. And so I think, for us and moving forward, that's definitely something we'll continue to try and develop, is making sure you have the right people at the table.
Absolutely. Folks, we've got a few more minutes left before we wrap up. So if you still have some questions, feel free to pop them in the chat. While you're doing that, or we might even get a chance for you to come off mute and have a quick chat as well. But before we do that, I'm curious, Steven and Lewis, do you have a kind of gold nugget piece of advice for founders if they're thinking about approaching a Series A?
Feel free to go, Steven.
No, you go
Perfect.
first.
I would say that the most important thing we did was reach out to investors prior to starting the raise to find out, to explain to them where we're at, what we're thinking of doing, being open and honest, finding out what they would expect to see for them to consider an investment of that scale, and then making sure that that fits into what you're planning on doing anyway. Don't change the whole company strategy just based on what the feedback of one investor. But start those conversations early, because you don't want to go down a path and then start the raise formally and find out that you've done something that no one likes, will never invest in, and you need to start untangling that. So it does not hurt to have those conversations really early. And yeah, that was probably the most important thing that we did.
Right, start those open conversations early. Steven?
No, I completely agree. And getting that feedback from the investors early on, in terms of what they need to see, what makes you investable. Completely agree with that. Super, super important. And doing it early enough that you actually have the time to put those things into play before you start asking people for money.
That makes sense. There's a question here from Ryan. What sort of revenue do you feel is necessary for a Series A in hardware startups if seeking investment in Australia compared to offshore, if you're able to comment? I know we spoke a little bit about making sure that you've got, you've crunched the numbers and you're looking at what's required, but any kind of additional comments around that?
We're not necessarily a classic example in that we already had revenue, not huge amounts, but we already had revenue going into the raise, and since the raise, it's grown quite a lot. But I've seen many companies raise off the back of kind of having no revenue, and I think that's fine. It's really, those companies have got the potential to be extremely large, and that's what the investors will push you on. So I think it's on a case-by-case basis, but I don't think having no revenue is necessarily a bad thing, but you do need to make sure that you have evidence that you're on a path to sizable revenue, either with agreements with customers, contracts in place, et cetera, et cetera. It can't just be an idea at that stage.
Yeah.
100%. So I mean, for us, we're still a fair ways off revenue, but without having that clear kind of pathway to significant revenue and profitability, etc., which will take us another 3 to 5 years realistically. Without that, there's no way we'll be able to raise. And so that forward planning piece, and again, like even the customer engagements, you're not going to be producing, in our case, lithium chemicals for a fair few years, but getting those early engagements and making sure that the customer is actually comfortable with the product that you will be producing and starting to lock up those early stage letters of intent, MOUs, whatever it might be, super important.
And one piece that you might not think about, but was immediately apparent for us, was make sure you have one customer who you're very friendly with, who knows that you're doing a raise. And I literally had one customer, like important customer of ours, who had to talk to about 6 different investors on 6 different calls. And at the end of it, I was just like, I'm so sorry. Like, I know this is a pain for you, but it's really important for us. And thankfully, they were okay with it. But I did have to say thank you many times to them.
Good to have a reference check. Joanne's got a question here just around, did you have a strong PR strategy sitting behind your Series A round? It sounds like both of you were driving it yourselves and didn't necessarily have external support. Maybe I've got that wrong though.
We didn't. I look back on it and maybe we should have. I think if we were going to target overseas investors, we'd need to have something like that. But no, it was all organic based on relationships that the team built with local investors.
Yeah, that was very much the same for us as well. So we had some news flow, but we didn't really have anybody external. We did it all internally. And we didn't really have kind of a strategy built out over a period of time. And again, going back, I mean, maybe we should have. But it's also one of those things when you're a startup, you kind of put the money to will give you the best return, right, on that investment. And generally for our kind of business, it's really kind of like on tech, to be honest. You have to develop the technology.
Looking at the time, I could see that we could obviously talk about this for hours and hours more and cover a whole heap more questions, but we know that you've got busy days to get back to. So we really appreciate you jumping in to talk about your Series A with us today. We really appreciate everybody who's jumped onto the call today as well, and a big thank you again for completing that industry report survey and supporting the Australian Climate Tech industry report and Climate Salad. Thanks, Olivia, for jumping on earlier and giving us a few quick highlights, and we look forward to seeing folks at the industry report launch in a few weeks' time. But yeah, big thanks again to Dr. Lewis Dunnigan, founder and managing director of Bygen, and Steven Vassiloudis, founder and CEO of Novalith. We really appreciate you taking the time and sharing your insights with us. And good luck, everybody, with your Series A. Thanks, everybody.
Thanks so much.
Thank you. Cheers.
Thanks. Cheers.